You know, when you walk into a casino, there is this unspoken fundamental agreement between you and the house.
Right, the rules of engagement.
Exactly. I mean, you know the odds are statistically against you. You know the house almost always wins over a long enough timeline. But you also know that at any given moment, you have the ultimate power to just stand up.
Yeah, you can always leave.
Right. You can take whatever chips you have left, walk over to the cashier's cage, cash out, and literally just walk out the front door. The rules are incredibly clear. You might lose your shirt, sure, but you are never physically or financially imprisoned by the building itself. You have total agency.
And that agency, I mean, that is the bedrock of any financial exchange.
Uh-huh.
Whether you're at a blackjack table in Vegas or, trading blue chip stocks on Wall Street, you have the right to liquidate your position.
Yeah.
The moment you remove that ability to exit, you're no longer participating in a market or a game. You are basically participating in a hostage situation.
Wow. A hostage situation. That is an intense way to put it, but it brings us right to the core of today's deep dive. So we are thrilled to have you joining us, addressing you, the listener, directly here as we unpack a single, utterly fascinating source today. We are looking at the Wikipedia article detailing the 2021 Squid Game cryptocurrency scam.
Oh, this one is wild.
It really is. Our mission today is to explore the anatomy of a massive digital illusion. We want to examine exactly how cultural hype, combined with the intoxicating promise of algorithmic wealth, completely blinded thousands of seemingly savvy investors to massive blinking red flags.
Yeah, the red flags were everywhere.
They really were. We're talking about a scenario where people voluntarily walked into a brightly lit, incredibly trendy digital casino, traded their life savings for special chips, and only realized after sitting at the table that the cashier's cage didn't actually exist. The exit doors had completely vanished. So, okay, let's unpack this.
Right.
Let's lay out the basic facts from the source. It's November 2021.
And the timeline here is critical. November 2021, the cryptocurrency market is in the middle of this massive historic bull run. I mean, my digital backdrop here is just a cascading wall of rising and falling crypto charts, and back then, everything was just going up.
Up and up.
Exactly. We were seeing meme coins minting millionaires literally overnight. Decentralized finance, or DeFi, is essentially the Wild West. It's operating largely outside of traditional regulatory frameworks.
And right in the middle of this financial frenzy, a brand new cryptocurrency called Squid Coin appears out of nowhere.
Right, trading into the ticker Squid Game.
Squid Game. And it is aggressively riding the coattails of the South Korean Netflix phenomenon, Squid Game, which was arguably the most talked about piece of pop culture on the planet at that exact moment.
Oh, absolutely. Everyone was talking about it.
And the numbers for this coin are just staggering. I mean, we aren't talking about a token that had a modest little run. This coin surged thousands of percentage points in a matter of days.
It was exponential.
If you look at the historical charts from that first week of November 2021, the price action looks like a heart rate monitor that suddenly spikes into a sheer vertical line. It reached a peak valuation of $2,861 per single coin.
Which is insane. A climb to nearly $3,000 a coin for a brand new, completely unvetted project is astronomical, even by the highly volatile standards of the crypto space.
Yeah, that's not normal.
Not at all. And to understand why people were throwing money at this, we have to look at the specific mechanism the developers used to lure investors. They didn't just market this as a fan token.
Right.
They marketed it as a play-to-earn cryptocurrency ecosystem.
And the play-to-earn model, that was the ultimate bait in late 2021, wasn't it?
Oh, it was the buzzword of the year.
Because you had other projects out there actually paying people digital dividends just for interacting with the platform, so the concept wasn't entirely alien to the crypto community. The pitch for Squid Coin was that buying these tokens granted you access to an upcoming fan-made online game.
Inspired by the lethal games seen in the Netflix series. Yeah.
Exactly. The white paper outlined this multi-level tournament. To play the first level, which was a digital version of red light, green light, you had to pay an entry fee in Squid.
And if you'd advance to higher levels, the entry fees increased exponentially.
Right. And you might even have to purchase specific custom NFTs just to participate in those later rounds.
It's just so clever. What's fascinating here is the psychological hook. It creates an artificial demand cycle. You buy the token not just to hold it as a speculative asset like a stock, but as an admission ticket to a game that promises to generate even more tokens as rewards.
It's a self-feeding loop.
Exactly. The developers painted a picture of a self-sustaining digital economy. The theoretical promise was that you could play this game, accumulate massive rewards from the entry fees of all the players who lost, and then swap those winnings out for established cryptocurrencies like Ethereum, or just cash them out for US dollars.
Man, it's just weaponizing cultural momentum. I mean, thinking about it, it's like buying extremely expensive plastic chips at a casino where the gaming tables haven't even been built yet.
That's a great way to put it.
Right. But everyone is throwing money at the dealer simply because the casino has a really cool, trendy movie theme. They were buying into a fantasy of participating in a high-stakes, winner-take-all tournament.
Without any of the actual danger.
Exactly. The Netflix series is entirely about desperate people competing in lethal children's games for a massive cash prize. The creators of this coin promised that exact same adrenaline rush, that same potential for life-changing wealth, but from the safety of a computer screen. You get to be the protagonist of the show, risking your wallet instead of your life.
And that narrative overlap is a textbook psychological exploit. The project successfully mapped the emotional stakes of a fictional television show onto a real-world financial instrument. And because it was built on the Binance Smart Chain and traded on decentralized exchanges, there were zero gatekeepers. Anyone with a digital wallet and an internet connection could participate. There's no centralized authority vetting the code before it goes live.
Which brings me to you, the listener, for a second. Think about this. Have you ever bought something entirely based on the fear of missing out?
Oh, the FOMO is real.
Right. Maybe a concert ticket for a band everyone is talking about, or a new piece of tech, only to realize later that you totally skipped over the fine print. Because the fine print with Squid Coin was a literal financial trapdoor.
A brutal one.
And here's where it gets really interesting and honestly incredibly dark. The entire plot of the Netflix show Squid Game is about people trapped in a game they cannot escape.
Yeah, that's the whole premise.
Once you cross the starting line, you are locked in until the bitter end. And yet, thousands of investors willingly poured real money into a cryptocurrency where the central fatal flaw in its smart contract was the absolute inability of the buyers to sell their tokens. They were trapped.
They engineered a smart contract with what's called an anti-dump mechanism.
Okay, explain that, because that sounds like a feature, not a bug.
Well, it can be. In the decentralized finance world, an anti-dump mechanism is occasionally used by legitimate projects. The idea is to prevent early investors, or whales, from selling massive bags of tokens all at once and completely crashing the price for the wider community.
So it's pitched as a stabilizing feature.
Exactly. But the developers of Squid completely weaponized this concept. They wrote the code so that purchasing the coin was totally seamless, but selling it required holding a secondary token that they called marbles.
Marbles, which is another direct reference to an episode of the show.
Yeah.
The audacity to name the locking mechanism after the most emotionally devastating episode of the series. But here's what baffles me when I look at the source material. The crypto community prides itself on the ethos of do your own research.
DYO, yeah. It's practically their mantra.
Right. So how is it possible that investors dumped an estimated $3.38 million into a digital asset without anyone, running a test transaction to see if the sell function actually worked?
Well, if we connect this to the bigger picture, it speaks directly to the arrogance of momentum trading and the blinding effect of exponential gains.
Greed, basically.
Greed. When a chart is printing massive green candles hour after hour, the fear of missing out entirely overrides analytical thinking. The line is going up so fast that if you stop to read the smart contract code, or if you pause to run a small test transaction, you might miss out on a 50% gain in the next 10 minutes.
Wow.
The velocity of the price increase creates this reality distortion field. You aren't testing the plumbing of the exchange anymore. You're mentally shopping for a new house based on a phantom number on your screen.
That is wild. And I was looking at the actual red flags, the Wikipedia page lists, and they are glaring. I mean, even if you don't know how to read a smart contract, the superficial warnings were everywhere.
Oh yeah, the website was a mess.
Riddled with spelling and grammatical errors. And the developer's Telegram channel didn't allow users to post replies. Their Twitter account had replies completely turned off.
A literal mute button.
Yes. In any traditional investment space, a company muting its own investors is a massive, immediate deal breaker. Why did a community that is usually so hyper-vigilant about scams just ignore a literal mute button?
Because a significant portion of those buyers likely suspected it was a highly risky play, or even a scam from the start.
Wait, really? They knew?
Well, they believed they could beat it. In the degen trading culture of 2021, there was this pervasive belief that you could ride a hype wave and jump off just before it crashed. They saw the red flag, sure, but the cultural power of the Squid Game brand convinced them that there would always be a greater fool willing to buy their bags at a higher price.
Ah, the greater fool theory.
Exactly. What they failed to realize was that the developers had already removed the exit doors. You can't beat a rigged game if the sell button is permanently disabled for everyone except the house.
The crazy thing about that astronomical $2,861 price tag isn't just the sheer number, it's the mechanical reality driving it up. If thousands of people are pouring money in and the code explicitly prevents anyone from taking money out, the supply of available tokens is effectively choked.
Right. The supply side is zero.
So the automated market maker algorithm has no choice but to artificially rocket the price to the moon.
It's basic math at that point.
Right. So what does this all mean? Which leads to the obvious question. If the regular investors couldn't hit sell, who had the master key to the vault? Because the money didn't just sit there in digital purgatory. The climax of this entire saga is a spectacular vanishing act. The value of Squid plummeted from nearly $3,000 to absolute zero.
In a matter of minutes.
In minutes.
Yeah. This is the execution of what is known to the space as a rug pull. To understand how this works mechanically, we have to look at how liquidity pools function on decentralized exchanges like PancakeSwap, which is where Squid was primarily traded.
Okay, break that down for us.
Sure. A liquidity pool is essentially a smart contract containing a pair of tokens. In this case, the worthless Squid tokens, and a highly valuable established cryptocurrency like Binance Coin or BNB.
So as investors are buying into the hype, they are sending their valuable BNB into this digital pool, and in exchange, the automated system is handing them the Squid tokens.
Precisely. The pool is steadily filling up with millions of dollars worth of real liquid value, while the investors' wallets are filling up with tokens that they are mathematically prohibited from selling back into the pool.
Wow.
Now, in a decentralized exchange, there's no corporate oversight. There's no customer service department. The developers who created the liquidity pool hold the administrative keys to that specific smart contract. While they locked the investors out of the sell function, they retained their own administrative privileges.
Oh, man. So to use an analogy, it's like setting up a currency exchange booth at an international airport.
Okay, I like this.
The scammers are running the booth. Travelers walk up, hand over millions of actual U.S. dollars, and the scammers hand back custom-printed monopoly money, telling them it's going to be the global currency of the future.
Right.
The travelers take the monopoly money, but when they try to trade it back, the tellers refuse the transaction based on some obscure fine print.
And then the rug pull happens. The developers use their administrative keys to invoke a function that withdraws all the underlying BNB liquidity from the trading pair.
They just take it all.
They take all the U.S. dollars out of the cash register at that exchange booth, pack it into their suitcases, and leave the monopoly money sitting on the counter. Because the underlying value backing the Squid token was instantly removed from the automated market maker, the algorithm immediately repriced the Squid token to its true value.
Which is zero.
Absolute zero.
The vault wasn't just emptied. The fundamental mechanism that gave the token any perceived financial weight was ripped out from underneath it, and the speed of the collapse is just terrifying.
It was instantaneous.
People were watching their portfolios display millions of dollars in unrealized gains, and by the time they refreshed the web page, the balance was literally nothing.
And that was followed immediately by the digital ghosting.
Right, they just vanished.
The source outlines the final chilling steps of the operation. The project's website went dark instantly. The Twitter account was deleted. The Telegram channel was erased. Any Medium articles or promotional materials published by the developers were completely scrubbed from the internet.
No trace left behind.
None. There was no customer service line to call and absolute zero accountability. They packed up the liquidity pool and vanished into the blockchain. This raises an important question regarding the inherent risks of these unregulated digital frontiers.
Yeah, the chaos of this unregulated space is perfectly reflected in the aftermath, specifically when you look at the attempts to track the stolen funds.
Good luck with that.
I noticed in the references section of the Wikipedia article, major media outlets couldn't even agree on exactly how much the scammers walked away with. They'd have Forbes reporting that the founders ran away with $2.5 million. A CNET headline cites $2 million.
Yeah, the numbers were all over the place initially.
Ultimately, the main text of the Wikipedia article settles on an estimated $3.38 million based on a broader postmortem analysis of the blockchain.
And that variance in the reporting, between $2 million and nearly $3.5 million, it really highlights the sheer labyrinthian complexity of tracking illicit funds in decentralized finance.
It's synonymous, right?
Well, pseudonymous. The blockchain is a public ledger, meaning you can see the transactions moving from wallet to wallet, but those wallets don't have names attached to them. The scammers don't transfer the funds to a bank account with their name on it.
Right.
They route the stolen cryptocurrency through a complex web of secondary wallets, coin mixers, and cross-chain bridges. These are all tools designed specifically to obfuscate the origin and destination of the assets.
It's basically a bank robbery where the police have the security footage showing the exact moment the money left the vault, but the getaway car immediately splits into 1,000 different vehicles driving in completely different directions, all with heavily tinted windows.
That is exactly what it is. And the robbers never had to step foot in a physical jurisdiction. They exploited a borderless, permissionless financial protocol. When you operate entirely outside of traditional financial systems, you're also entirely outside of their protections.
Your safety net.
None. There is no FDIC insurance to cover your losses. There is no central bank you can call to reverse a fraudulent transaction. The code is the law. And in this case, the code was maliciously designed to trap the user.
So to synthesize this deep dive for you, the Squid saga was not a technological failure.
Not at all.
It wasn't a bug in the system or a project that simply ran out of funding. It was a perfectly executed, highly premeditated psychological exploit. The developers took a beloved, massive cultural touchstone, a show that had gripped the global consciousness, and they weaponized its narrative.
They knew exactly what they were doing.
They combined that cultural relevance with the highly dangerous speculative frenzy of the 2021 crypto bull run. They built an anti-dump mechanism disguised as a feature, locked the doors from the outside, and executed a multi-million-dollar disappearing act in broad daylight right in front of everyone watching the charts.
And, it leaves us with a rather haunting thought to mull over.
Yeah.
The architecture of this scam perfectly mirrored the dystopian, inescapable trap of the television show it was named after.
It really did.
It is a stunning piece of dark poetry. The creators of Squid literally built a financial system based on a fictional scenario where desperate, greedy participants are ruthlessly eliminated for the profit of an unseen VIP class.
They broadcasted their intentions right in the title. They named their token after a lethal trap, and people still lined up to buy it.
Which forces a very uncomfortable reflection on human nature, honestly, and the allure of exponential wealth. If a digital illusion can be this overtly transparent about its dark narrative, utilizing mechanics that explicitly prevent you from leaving and still succeed to the tune of over $3 million,
Yeah.
are we destined to keep willingly walking into these traps just because the flashing lights of the jackpot look bright enough?
Oh, wow. That is a phenomenal question. It strips away all the complex technical jargon of liquidity pools and smart contracts and gets right down to the raw psychology of greed.
Yeah, exactly.
It forces us to ask what glaring, obvious red flags we are willing to completely ignore the moment a chart starts glowing green. Well, thank you so much for joining us on this deep dive. We hope it gave you some fascinating insights into the mechanics of decentralized finance, the power of cultural hype, and the intricate anatomy of a digital rug pull.
Thanks for listening.
As always, stay curious, stay critical, and before you sit down at any new table and buy into the hype, always make sure you locate the exit doors before you hand over your chips. We'll catch you on the next deep dive.